What's going on, everybody? So I hope you guys all like that. As people are piling in, we saw the numbers going up, so we just wanted to give it a few more minutes as people plow in. Hopefully every one of you got out and voted. I know I did. I know my whole family did. Pretty important election tonight.
Got my sticker right there.
There you go. So one sticker. How many of you voted? Give us an I in the chat. Or how many of you are going after tonight's training? Because that would be a great time to go. All right. We got some voters. Hell yes. Well, pretty much. All right. Dumb question. I guess you all voted. You know what? It's like when I walked in there, normally there's really no line. Today there was a big line, which is good. A lot of people are understanding that there's a lot at stake, and there's a lot at stake for a lot of things, which is what we're going to talk about tonight. So Stephen, I'm going to turn it over to you. You kick us off however you want and we'll roll.
Welcome. So what Chris and I decided to do, and just give me a quick idea, everybody that's on right now, just put a 1 if you're new to the Chris Noggle Money School Network. Like this is one of your first trainings. Just put a new or put a 1 in there. That's easy. I just want to get a good idea. I see a lot of familiar names on here, a lot of names that, have been on several trainings in the recent past. So it looks like we have quite a few new people as well, Chris. So, all right, that's awesome. Well, so welcome to the Money School. Chris, maybe you can do a quick introduction on yourself. My name's Stephen Nagy, but Chris and I have been working together now for going on 4 years now. And our entire thing is teaching you how to take back control of your money and solve your money problems. So putting you in control of your future, so to say. So if you've ever wanted to learn how to invest, how to grow your wealth, how to control your wealth, how to be an entrepreneur, how to save on taxes, lower your tax liability, keep more of your hard-earned money, beat things like inflation. If you're sick of your 401k, watching that thing just drop all year long, and the volatility, the ups and downs, and the sleepless nights of not knowing what's going to happen next for you and your family financially, or maybe you've made a lot of money and you want to protect it right now, and you want to make sure that no matter what happens with this recession or depression or whatever is going to go on, that you are safe and your money in your family and that legacy is going to remain in place. That's what we're here for tonight. So what we're going to do is we're going to introduce you to what the Money School is, what we are doing right now, and what thousands of our clients at this point have also been able to implement and change their families and their financial lives forever. So I'm sure you're going to see a lot of people commenting on here, welcome to the new people, and you guys have changed our lives and we love to see it. First and foremost, our clients are everything to us. So Chris, just anybody that's new, if you don't mind, just kind of, you've been doing this for a long time, but what's that look like for everybody?
Yeah, so thanks everybody to the new followers, the new viewers for the first time. Hats off to you. You're willing to give your time, your energy, your effort to learn something new, and I commend you for that. And then all of our veterans, we got a lot of people that have joined us for just about every week. We do, Steve, how many do we do now every week? Is it 6 live shows, or are we up to 7 live shows now?
We're doing like 6 live shows every week, and we got a couple new ones that we're going to be introducing here soon as well. So yeah, we put out a lot of free content. Absolutely.
Yeah, and I think the most important thing that we're going to hit tonight, as many of you saw, the title of this webinar is Now You're the Bank, what now? And the whole idea behind this comes not from what I learned, in the 16 years of being a financial advisor, the Wall Street stuff that I did. They taught me a lot about traditional investments, your traditional IRAs, your 401ks, stocks, bonds, mutual funds, ETFs, annuities, all that stuff in a baseline on life insurance. But what I was always taught, about life insurance for the most part is buy term, invest the difference. How many of you have ever heard buy term, invest the difference? I bet you if I ask all of you, every single one of you would say that. Well, that's what I was taught. 16 years I did that. And where it all changed for me was when I started getting around real estate investors, not just any real estate investors, but really high level, high net worth real estate investors. This was my first entry into the ultra wealthy. I had wealthy clients, but I never had ultra wealthy clients. And as I started to go into masterminds and learning what these wealthy individuals were doing, the disconnect for me was, the first person that told me what they were doing, I really didn't understand it. So I kind of just discounted that. And many of you tonight, you're going to hear some things, learn some things you're going to discount. But as you keep going, you're going to keep hearing and seeing this, because tonight's information is incredibly timely. And that was me back then. I started getting this information from these really high net worth guys and gals, but it wasn't just one. As I got in this circle, I started seeing it over and over again. And every time when I ask somebody, what are you doing? What are some good investments? What do you, how are you investing? I always thought they'd come back to saying exactly what I knew being an advisor. And the fact of the matter was, that was hardly at all what they talked about. Everything they talked about was the complete opposite of what I learned to do and what I learned to sell as an advisor. So after a little bit of this, you start developing almost a complex, right? A reality complex, if you will, because what I thought I knew wasn't what they were doing. And then all I wanted to do was learn. I wanted to learn, well, okay, if all these guys are these wealthy individuals, these wealthy folks, well, if they're doing what I am not, then maybe I should hang around and try to figure this out. And it all started at a cheesecake factory in Salt Lake City. I was meeting with this guy, Mike, very wealthy individual. And if I gave you his last name and you Googled him, you'd know exactly who he was. He was lending me and my wife money for our flips. And when I started really diving into the conversation, one thing became obvious. He started talking about banking. Now, I was in Wall Street. I talked about investing. He was talking about banking, something that I wasn't all that familiar with. I knew of a bank as a place where I took my paycheck, deposited it, and I never really was happy with what the bank paid me. But I never understood banking. So he's talking about that. And then he says, I asked him, where are you getting all this money to lend? And he leans in and he says, from my bank. Now, I thought literally that meant he owned a bank. So in my mind, I'm thinking, well, why aren't we at your bank? Why are we sitting here at Cheesecake Factory? Maybe the guy was hungry. But I learned he wasn't talking about a bank that he owned. He was mimicking what banks do by using the system that we teach, a system that you're all going to learn a little bit about tonight. But it wasn't just this system that really changed it. The whole idea was everything I thought I knew wasn't what wealthy individuals were doing. And I want you to really hone in on one thing in what I just said. This isn't about teaching you just about the wealthy secrets and what the wealthy do with money versus what you might learn from your advisor and watching the news or anything that you might get information. What I really want to focus on tonight is what's going on today. Because it doesn't matter what happened a year or 5 years or 10 years ago. And it doesn't matter really what is going to happen in 10 years from now. What happens right now and what's unfolding under our eyes and right underneath us tonight is what we need to talk about. So right now, you all know this is an important election, an election that then will stem into a lot of other really either exciting or really heartbreaking things that happen over the next couple of years. But nonetheless, if you peel the onion a few times, you will see what's really going on. And what's going on is something that I can't really explain, but something that I can tell you has happened before in history. We're at the end of a cycle, not just one, we're at the end of 3 different cycles. Now, at the end of these cycles, I can tell you there's only one direction it goes. And tonight, what we're going to do is hit some of the high level things that you're seeing behind. We're going to open up and I don't want to say bore you, but I'm going to point out some things that you might not see by watching the news. You might not see talking to the people that you surround yourself with, but things that are happening right now that are going to absolutely affect you, affect your wealth, affect your assets, and affect your family's financial future if you don't get this right. And I can't be more clear about that, because what is happening right now means we're going down. And what do I mean by down? Well, I mean, the Fed, Jerome Powell, has clearly said what their intention is to tackle inflation. We're at 8.2. They've been raising interest rates all year. Any of you that are trying to buy a house, a car, an RV, a boat, looking at your credit card, looking at your home equity line of credit, looking at any debt you have, you've noticed one thing. The cost of everything has gone up, including the cost of borrowing money. But you've also noticed one other thing too, is when you deposit money in the traditional bank, they ain't giving you any more money. Your interest rate has barely gone up at all. And most people are too busy in their daily life, too busy hopping on planes and trying to get what you can get to experience the world, because we've been locked up for 2 years. If you're in California or New York, where I'm at, you know exactly what I mean. So this has been revenge summer. Let's go out there, let's travel, let's do all the things we haven't been able to do for 2 years. And in doing that, you might have missed a couple key indicators that have been happening right underneath all of what you're doing that are telling you exactly what's coming next. And what's coming next, as the media has already begun saying it, but we've been saying this for a long time, it's called a recession. Now, here's the scary thing about that word recession. Many of you, if you're under 38 years or younger, 38 years old or younger, you probably don't understand the impact of a recession. Now, anybody that's over 38, you probably do. Many of you have gone through 2008, so you clearly understand what happened there. Some of you went through dot-com crash in the 2000s. Clearly, those of you that went through that know what happened. But these are the signs and the facts that you're going to have to live with in the next year or 2 years. Now, I'm not trying to be doom or gloom. I'm not trying to scare any of you. I'm trying to be real with you. I'm trying to give you the truth of the situation. And you know what? I got bad news. The truth hurts. And it's going to hurt a lot of people. Because here's what you may not know about a recession. Oh, it's a fancy word, this, that, and the other thing. But a recession means many of you are going to get laid off. A recession means that many of the people that you surround yourself are going to get laid off or lose your job. Many of you are going to have drops in your income. Most all of you, if you haven't been around our campfire listening, when you look at your 401k statement, you get that funny feeling in your gut that doesn't feel good, right? Because it's down 20%. But I know, oh, it's coming back, Chris. You know, the last couple of weeks it's been coming. We're going to be okay. Wrong. This is all an illusion. This is all a trap. This is because it's an election period of time. And that's what you need to realize. And this isn't the first time this has happened. Go back to 1929. The exact same thing happened in the summer there. What came next? The Great Depression. Folks, listen, I'm not trying to really paint just a bad picture, because tonight what we're going to talk about is what is next. What do you have to do to get ready for this? How are you supposed to position? How do you get ahead of this? How do you get yourself in a position very quickly so that you are so ready for a recession or a depression or whatever the Fed and the markets throw at you that you only see opportunities? Now, if that's not what you were looking to get out of tonight, you're in the wrong place, because that's what we're going to deliver. We're going to give you tactical, tangible reasons why you need to start getting things ready, get your house in order, get your finances in order, and we're going to really paint the picture of exactly what this recession could look like based on past recessions. Now, here's some good news. We looked up some data, and Steven's got this. Recessions, the average length of a recession, 15 months. Now, some of you hear that and you're like, oh my God, that's a long time. And some of you are like, you know, that doesn't seem like all too bad. 15 months, it kind of comes, you know, we have some pain, but then we're back and good. Wrong. That isn't what I'm talking about. Now, whether the recession goes for 6 months, 8 months, 15 months, or God forbid, it could be a prolonged couple-year-long recession, or then it would be called the Depression. It doesn't matter how long it's going to be. The damage, you know, think of that hurricane that just hit Florida. Now, we all saw the damage on the screens. We all talked to people that, you know, had damage, but that damage will have repercussions for years to follow, maybe a decade in some of those places. They will be rebuilding and putting things back together and spending unheard of amounts of money rebuilding that because of that hurricane. Now, you can't control a hurricane, but what you can do is you can plan and prepare for one. And I bet you the people that planned and prepared had less damage than other people that did not plan and prepare. Now, market chaos, like what we're going through right now in a recessionary period, is absolutely something that you can prepare for. But the good news is, unlike a hurricane, is no matter what, you're going to have some, you know, damage and some negative effect. This, if you prepare properly, if you get yourself right, if you get yourself positioned right, and I don't mean moving things too much. I mean, your 401k, let's show you how to reallocate that thing. The money that's in your bank account, let's get that money working for you in a place where it actually isn't going to have to worry about market downturns or interest rates or inflation, where it just grows in a guaranteed environment. Like, all these things are absolutely possible. These are all things that the wealthy have been doing for years and years, decades and decades, centuries, but we haven't, because we're always a little bit late. We're always chasing the wrong thing. When you think something's a good investment, chances are it's probably not. You probably missed the boat. And many of you right now are getting warm and fuzzy feelings because the markets have been going up, thinking, oh my God, it's time to come back in. It's time to get back in. We must have hit the bottom. Oh my God, I'm missing out. The temptation is almost unbearable. But the first and foremost thing I can tell you, don't take the bait. That's exactly what it is, folks. If you think the markets are going to continue to keep going up, I'll put it all on the line that you're wrong. And I'm not saying I'm not trying to be the right guy here, but I've been pretty damn right up to this point. We not only called that this was coming, we told you why it was going to happen. We've also told you what the first leg was going to look like. We've told you how to reposition and get ahead of this thing. We talked about the impact of inflation, and we talked about the impact of rising interest rates. And we also have been talking a lot about the impact of the Fed's actions, which they've done before. We've talked about the inverted yield curve and what the impact is of that. All those things are simple indicators that most people just ignore, but we didn't, and we brought it to you in a simple way, because even if you didn't understand what I just said, you now need to basically understand what it's going to mean in the future, because if you don't, well, how's another 20 or 30% off your 401k look? Probably not good. How does your money sit in your bank account look if it gets frozen because that bank has financial difficulties? Ask some of the people that had money in some of those crypto accounts that their money is still locked up and frozen. Well, because they got greedy. They bought into FOMO and they bought into temptation. So folks, I'm not here to just sit here and call out all the bad things, but I'm just trying to get you to wake up. I'm trying to get you to realize that there is a real problem ahead of us, a big problem that all of us have to go through. The difference is some of you are going to lose a whole bunch of money, and the other some are going to make a whole bunch of money, because when one person loses, another person gains. Which one of those two people do you want to be? And please tell me that you said the person that gains, because if that's not you, again, I got to ask, why are you even here? So Stephen, where should we go first?
Like you said, with the traps, the market's been coming back the last few weeks. Maybe politics plays into that, irregardless of all of that. And maybe we can get to this a little bit, you know, some of the studying that you do, Chris, of these economists and different long-term and short-term trends. And because the fundamentals at the end of the day tell us that everything that we're in right now is a big bubble and that we're going to have a pullback. So if those of you that remember 2008, and we saw that crash, and if you look back to 2001 with the dot-com crash, and then we look back in history, history tells us that every time there's a crash, what that really means is it's a time when there's a gigantic transfer of wealth. You have to remember, when the stock market comes down, when you're losing money, that means somebody else is making money. Wealth doesn't get created and disappear unless the Fed is printing it, which is a different story, which has led to a lot of this inflation and everything. But with fundamentals, wealth is transferred. So when you hear about market crashes and recessions and people losing their jobs and financial hardships, what that really means is there's someone else out there that's able to be smart and take advantage of that and set them and their families up for success. Now, with that being said, money's not everything, okay? And I want to be very clear about that. Chris and I, what we do is not based at all on money, okay? We share this information because we truly care, and we truly know that if you can learn these concepts and these strategies that we're teaching you starting right now tonight, that you will be able to not only survive what's coming, but thrive and do very, very well for yourself. But you have to be prepared for it right now, and you got to be set up for it. So that step number one is understanding what's coming and why it's coming. Step two is going to be, what do I do to start positioning my wealth, my money, my situation to be able to start taking advantage, not lose what I have, and be able to start taking advantage of what's coming? Because we're going to talk tonight a little bit about ways to start doing this. So just to give you a quick little idea real fast. All right. So we talk a lot about the market and the opportunity that's going to create. And that's very, very important. Right. But at the end of the day, we want to look at the pillars of what we're building. And so we're going to talk a little bit about real estate tonight. We're going to talk a little bit about money and being the bank and what that means to you. And we're going to talk about the legacy that can create and how all of these come together. So when we look at that, what we really need to do is take a step back and say, okay, where are we starting today? Because Chris, the subject of this is what's next, right? Or what's now?
What's
So
now?
to understand what's now, we have to understand what we do have right now. So I think, Chris, we should talk a little bit about maybe, you know, what's leading up to this, but more importantly, where is your money right now? Because I opened up with, we teach you to take back control of your money. So where is your money right now? So for me, there's three buckets of kind of what that looks like. So we have like our retirement accounts, old 401ks, current IRAs, whatever that retirement funds might look like. And then we have our cash. This is our money that we're investing, maybe in the stock market, maybe in real estate, maybe whatever that might look like. But where are we investing our money, or where's our money sitting? Is it sitting in a savings account at the bank? Is it sitting in CDs? Is it in annuities? Where is that money? Okay. So where can we put that? That's everything that's not retirement money. And then the third bucket is business, is leverage, is that entrepreneur mindset of being able to be smart with those other two buckets and leverage everything that you have and take that to the next level. So I think that's what we should kind of do, Chris, is, let's talk about what that looks like. And then just to let everyone know right up front, there's no way we can teach you all this stuff in an hour and a half. So we need to set up the foundation tonight, and that's going to roll into tomorrow. So tomorrow at 1 p.m. Eastern, we have another free webinar. It's the Wealth Webinar series that we do. So tomorrow we're going to continue this conversation. And then from tonight and tomorrow, we're going to spend 3 entire days with you on Friday, Saturday, and Sunday, showing you exactly what you can do right now with your money, whether it's in those retirement accounts, whether it's cash, whether it's investing, whether it's your business, whether it's your real estate, whatever that is for you, how you can start actually moving that money and setting yourself up to take advantage of what's coming. So we're going to spend, I don't know, 10 to 4, 6, 12, 18, probably almost 20 hours this weekend with you, going in depth about everything that we're setting up tonight and tomorrow on the Wealth Webinar series. So I just want to make that very, very clear from the start. Is everybody okay with that? You're going to have to commit a little bit of time to be able to understand this stuff so you can put yourselves in a position moving forward. And if you're okay with that, Chris, then I think we should start getting into this right now.
Yeah, I do too, because the lazy cash just came out. For any of you that are brand new, right here in front of me, you're probably wondering, well, why does a guy have a cat on his desk? This cat lives in the office. He's got an 8,000 square foot office facility here where he basically roams, and he shows up to every training. And most people want to see the cash more than they want to see me. Is that not true? So lazy cash, I want to start there. So the cat was named after something we teach and something that we talk about a lot, and that is literally lazy cash. So by just a show of hands, all of you on here, can you tell me how many of you have equity in your house right now? So based on the amount that you owe on your mortgage, is your house worth more, and do you have positive equity in your primary home right now? If you do, put I in the chat. I don't care if it's an I or an AYE. Let me know how many of you have lazy cash. Well, that's where this cat gets his name. He was a little stray that we found out on the street. We brought him in and gave him an 8,000 square foot palace for himself to roll around. Your money that mimics the cat's name, lazy cash, is sitting lazy in your rafters of your house. Now, I'll come back to this in a second, but I just want to do a real quick thing. A lot of people don't quite understand that. I just did lunch with a good friend of mine, and he told me while we were doing lunch, he said, I have $1 million in equity in my home. And he said, and I said, okay, well, how does that make you feel? And his answer was spot on. He's a smart guy. He said, it makes me feel stupid. And I'm like, well, okay. And I asked him to explain that. Now let's just use that number. Now I don't care if it's 1 million or 100,000, but we'll just use his. Okay. I don't care what your equity is. Maybe you got 10,000, maybe you got 100,000, maybe you got more. The number's irrelevant. So this is just that person. He's got $1 million in equity sitting in his house. Okay. Now, the first thing that you need to understand is that right there makes somebody feel really good. And for the middle-class Americans, this is the majority of where their wealth sits right now, in the price of their house. But then I want to also talk about why he felt stupid. Well, here's why he felt stupid. This $1 million sitting in his house makes him feel warm and comfortable, but also does nothing to change his life. So any of you that put I or AYE or however you did it about equity in your house, this is doing nothing to change your life. Now, let me just put it this way. So that equity in your house can be tapped into a couple different ways. So let's just hit the most obvious. We all know what a HELOC is, right? A home equity line of credit. They're very easy to get. Like if you have decent credit, decent income, the bank right now, and I want to preface right now, chances are they would give you anywhere between 70, and we know some banks that go up to 90% of the equity in your house. So let's just do the math. For this individual, that means he is missing out on having access to anywhere between $700,000 and $900,000. So what could he do with $700,000 to $900,000? Now I'm just going to kind of go into just an example. Let's just say he had some credit cards. Now, I don't know if he does or does not, and I know he's got a car payment. So he's got a car payment and some credit cards. Let's just say that car payment, let's say he owes 100 grand. I know he drives a really nice car. And let's just say he owes 20, 50, and then I don't know, let's do another 30. We'll make this $100,000, okay? He owes $100,000 in credit cards and $100,000 on his car. So he's got a total debt load, if we just use that, of $200,000. So most people would look at this and they would say, okay, we'll use the equity from the house to pay off the debt. Now that's great, but let's go one layer deeper. For him to access this equity in his house right now, I don't know what HELOCs are going for, but I believe between 6 and 7% as of right now. And as they raise interest rates, this will get more expensive. Now, let me ask you a question. What does the average car loan cost? I can already tell you, and you guys can Google it yourself, about 5%, okay? Credit cards, I will tell you right now, I just saw somebody's credit cards just yesterday, and the average credit card is about 25%. Because if you all thought that those credit card rates were going to stay low, that was just because we were in a low interest rate cycle. So let's just say 29, 15, and let's just say this one's 20% on the nose. 5%, 29%, 15%, 20%. Let's just add all these up. So we got 20 plus 15.99 plus 29.99 plus 5%. That's 70. If we add them all up, it's 70.98. Now there was 1, 2, 3, 4 debts. So let's divide that by 4 to get the average. His average interest rate that he's paying is 17.74%. So let's just round this up to 8%. Let's factor in that rates could go up. Can anyone tell me what 7.74 minus 8% is? I just want to write it right in here because this is what's called a spread. Some might call it arbitrage, but let's just call it what it is. 9.74, well, let's just round it there. 9.74% is the positive spread that my friend is leaving on the table if this were his situation. So now let me just ask you a silly question. How many of you would like a risk-free return of 9.74%? I mean, I hope that's all of you. Remember, all of us are so concerned because the media's got us all fixated on the inflation rate of 8.2. Well, right here in this example, if this was just debt, his spread is 9.74%. And what does he have to do to make this spread happen? One thing. He has to make the money that is sitting lazy in his house go to work for him. Does everybody understand the simplicity of that? Because here's the thing I don't understand. I talk to people, Stephen talks to people. We've got about 23, or it might actually be a little bigger. Let's just say 23 people on our team. We talk to people every day. Stephen, how many people do you run across that have money and equity sitting in their house that they've done nothing with it?
A lot.
A lot. And how many of those same people that have money and equity sitting in their house, many of you were those people, but then they have debts, car loans, boat loans, credit card loans, lines of credit loans. How many of them have these?
A lot as well.
So if the answer was that simple, is I'm going to go to the bank and I'm going to get a home equity line of credit, and it's going to be, I rounded up to 8%, which is more than what any of you are paying on your home equity lines. And I just showed you if this was the normal math, it took us a couple seconds to figure that out, that the positive spread would be 9.74, right? So then why wouldn't you go to the bank, open a home equity line of credit, and get this done? Now, we don't sell home equity lines of credit. Your bank does, your credit union does, your community bank does. And if you can't get a home equity line of credit, no problem. There's home equity loan agreement. So let's get rid of credit and let's put loan agreement. You're going to hear from somebody this weekend that's going to show you how to tap into the equity of your house, but never have to worry about a credit score, never have to worry about your debt to income ratio, and never have to worry about a loan or a loan payment. Yes, you heard me correct. You can get the equity out of your house without ever having to actually have a monthly payment. Is that something you want to learn about? Well, we have somebody coming on that will teach you all about that. But let's just stick to the home equity line. Let's keep going, right? Some of you on here are like, I don't have a car loan. I don't have any debt. I've done a good job. I paid off all my debt. All right, great. So that just means you just want that warm and fuzzy feeling of the equity in your house. But what if I told you that there's a very strong probability that in the next, I don't know, year, maybe 2 years, that the equity in your house could drop between 10 and as much as 40%. So what if that was the reality? What if the equity in your house, that $1 million that makes you feel warm and fuzzy, was now only $600,000? Okay, and that's if you had $1 million. Let's start chopping this away. Let's say you only had 100,000. Okay, now you only have 40,000, or I'm sorry, 60,000 less. This is reality, folks. Every recessionary period, which is what we're going into, every one of them has another component called deflation. And just so you all know what deflation looks like, it's actually quite simple. It looks like this. Okay, the asset price of everything around you goes down. It deflates, including your house. You're seeing it happen already, because as the Fed raises interest rates, as housing becomes more expensive, not because the house price is going up, but because the financing cost to own the house goes up tremendously. I'll show you the math on that in a little bit. Your house has to come down in value. Mathematically, probability, or mathematical and 100% probable, this will happen. How much? I don't know. Depends on where you live. Higher appreciating areas will come down more. Lower appreciating areas will come down less. But I can tell you that could very well be reality. So do you really want to lose that much of the money that you have, or do you want to get that money working for you? And now let's go over to that person that said that they had no debt. Let's actually take this back up to $1 million so that we're talking the same thing, because we're already talking $1 million. Doesn't matter if it's 100, just drop a zero. Now, someone's like, okay, yeah, I have no debt. I don't know what to do. Great. Some people like real estate. They like to invest in real estate, right? It's a solid investment. Even in a recessionary period of time, people need housing. My phone has been ringing off the hook for people calling me that know me, asking if I have any apartments to rent. And unfortunately, I have none. I have no apartments to rent. All of them are fully occupied and have been for a very long period of time, because people don't want to move out of their houses right now because they can't afford to buy the new house anymore because rates are too much. Housing, rentals will become incredibly valuable. But let's just say you don't even want to own real estate. There's other people that do want to own real estate, and they're all going to need some money. And let's just say we get into this recession and all of a sudden the good old banks no longer want to loan any money. And let's just say in a short while, the same thing that happened in 2008 and .com and 1990 recession, the 1980s recession, let's say the same thing happened, you might not be able to get a home equity line of credit either, because the banks will freeze up, tighten up their lending provisions, and not lend money out. It's already happening. Don't believe me? Go to your bank and try to get a loan. Call your credit card and try to increase your limit. It's a lot harder than it was a year ago. It's already happening. So if you wait on this, if you're like, oh, we'll get around to that. No, you won't. Number one, your house will lose value. And number two, the bank might not even give you a home equity line. So the time is right now. So this whole thing is called what now? This is now. Okay, so people that need money, they no longer can go to those hard money lenders because the hard money lenders seize up and they're not lending. Those people that normally would go to the bank to fund the rental can no longer get funded from the bank. So where are they going to go? Well, you all maybe have heard of this thing called PMC that we created, Private Money Club. They're going to go to you because you got all this money sitting in your house, your equity that you've tapped into because you were smart and you actually listened and you went out and got a home equity loan line of credit or a home equity loan agreement, and you've got that home equity line and it only cost you 8%. Now, most of you are like, oh my God, that's expensive. Well, what if you could lend that money out to this guy over here who needs money for this great rental, which he's already got fully occupied and it's already cash flowing. All he needs is money. You've got the money right here. You've got the money right here, and your cost for that money is 8%. So let's just say you take this money and you lend it to this person. Okay. So now we're going to draw it over here. You lend it to them in a first secured position, meaning if this person defaults, doesn't pay you this awesome rental, guess what? It's now yours. You didn't have to own it, but you fully controlled it. Own nothing, control everything. And the whole time that that person was trying to buy this, they paid you 15%. So let's just do the math. Stephen, what is 15 minus 8?
7.
A positive 7%. Not too bad. Not too bad at all. So folks, you see what I'm saying? This is lazy money that you're just leaving. Before it was 9%, now it's 7%. Doesn't matter what it is. It's money you don't have today because you failed to leap and get this done. Now, here's the good news. They are still giving home equity lines of credit. I know for a fact because we're on the phone with the banks quite often asking them. We have our clients telling us, yes, we just got a home equity line. My question is why haven't you yet? Because if this is the spread, and I only did a couple examples, you are missing out on this.
I mean, just one thing that when I first met you, that's always stuck with me is this on the screen right here. It's never about your actual resources. It's about how resourceful you can be. And just think about just what you just showed right there, how you're taking, the way that most people look at their debts and what they're doing in their homes and just changing that one little thing. Instead of getting additional resources, putting more money, just taking what you already have and being smart with it. Look at what we were able to do, create 7-9% returns using what most people would not even realize is there for you. And, when we start getting into things like investing and how you take, how you can raise money and what that looks like. I mean, just to give you a quick idea before we jump forward, I mean, here's some of the different topics we're going to be hitting on, again, in depth at the 3-day this weekend. And this is why it takes 3 full days to teach this stuff, because we get into so much, but you just start looking at the way that the banks work and how to leverage the banks and different types of banks to use and when to actually becoming your own bank and what that looks like and everything in between. So I'm just going to throw some little teasers out as we go here, but this on the screen right here is everything and more that we're going to start talking about this weekend with you guys.
So folks, this is something, this is a little old. This is from the last 3-day that we did when they had just started raising interest rates. And Stephen, if you could, while we're doing this, could you get up like a bankrate.com mortgage calculator? Because I want to play some numbers and I want to show you live, like we'll actually put it up on the screen. I want to show you the impact that rising interest rates are going to have. Now, most of you aren't seeing these impacts. Most of you are hearing what I'm saying and still being like, it's not, I don't know. You're still skeptical. And the reason for that is real estate is a lagging indicator, meaning when the whole stock market crashes and burns, when everything starts falling apart, real estate doesn't. It takes between 6 to 9 months for real estate to start feeling the impact. We're feeling it a little bit faster because the Fed's raising interest rates so aggressively. And I want to show you the impact of what aggressive interest rate raising does to the cost of the average middle class or any class American out there. So this is old. All we did is we first estimated that the Fed was going to raise rates 7 times. That's a fact, not an opinion, not a speculation. Absolutely, positively, they will continue to raise until they've done it 7 times. We estimated back then that they were going to raise it between 25 and 50 basis points. I got bad news. We got it wrong. They raised them a lot more than that. The last 2 were 3/4 of a point increases. So what we did is we did the impact, okay, on 7 increases at 25 basis points, which would be 1.75. They have done far, far more than that because they've done 50 basis points. Then they went 0.75%. The average house back then in this nation would cost $350,588. It's more today, okay, but this was then. So 2021, we remember, these were the good old days, if you all remember, a 30-year mortgage just 1 year ago was 3.5%. And you guys would have said that that was expensive back in 2021 because in 2020, it was like 2.97%. So this is what I'm trying to explain. This is relative to the times, and this is what now, okay? 3.5%, which means if you put 20% down on a $350,588 house, your monthly payment would have been $1,259. So Stephen, on a piece of paper, could you just write $350,588 and then just write that just a year ago, it would have been $1,259 a month. Back then, what we did is we figured the Fed was going to raise rates 25 basis points. They went more than that. And what we did is we just went over here to a couple months to March 2022. God, it feels like it was yesterday, but this is March of 2022. A 30-year mortgage in March of 2022 was 5%. It was actually a little bit more. 20% down on the same price house, that monthly payment went from $1,259 to $1,505. If we did the math on that, the difference, okay, just the difference every single month was $295, okay, or I'm sorry, $246 a month. That was the difference. Times 12 months is $2,952. So almost $3,000 a month more for the same house for just a small interest rate increase. And then we're gonna go to where we're at now in just a moment. Okay, that means over 30 years, if you were to hold that house and pay that mortgage off, you would have paid $88,000 more for that same house, and that was then. So real quick, Stephen, let's do this math all over again. It's $1,259. Let me get rid of this screen.
Yeah, I have it up.
Okay, let's just do it. Pull the calculator up, and I'll just follow along. Because remember, before we were at $1,259 for a $350,000 house.
Yeah, so $350,000 down payment would be $70,000, right?
Yeah, 20%.
30-year, it's telling me the current rates are 7.22. Did you include taxing and stuff, or are we doing that?
No,
to
just skip all that.
Oh, so here we go. Principal and interest, 1907.
Okay, can you do 1907 minus 1259?
That is $648 a month.
The hell of a nice
Increase.
car that you could buy for 648. 648 times 12.
Is $7,776 per year. Over the
All right.
course of a 30-year mortgage, that would be another additional $233,280.
So folks, I just want you to look at that. That was very quick. All of you could do the same math. That's the impact of only a few short months from March until where we're at now in November. The same house, the same price, the same down payment. That house is going to cost $648 a month. Now, some of you might think, oh, that's not a big deal. Well, maybe not for you. But what if you lost your job? Okay, what if you were on unemployment? Could you afford that? No, is the answer. That's not really the big impact, though. So remember we talked, many of you are still thinking the price of real estate isn't going to go down. It's going to go up because there's so much demand. And me and Stephen got beat up terribly on this. We had mortgage brokers and realtors saying, we're out of our mind. We're totally wrong. There's no way real estate prices are going to go down. They substantiated with all the demand and all the people that wanted to buy houses and the shortage in supply. All true. But math doesn't lie. Opinions, speculations, they do. So the math behind this, I don't have it in front of me. Stephen, I don't know if you could find this. How much income? So the average person, if they had to pay $648 more a month for the same house, that means for the bank to qualify them for this house, they'd have to earn a hell of a lot more money. How much more? I'll bet you, I don't know, what is the math? About $20,000 more for $648. I might have it off a little, but we can figure it out pretty quickly. So that person, what are they going to do? Just go to their boss and just say, hey, boss, you know this inflation thing and how this stupid Jerome Powell guy keeps raising interest rates? You know, I got this house under contract, but my rate lock expired and now my payment's going to go up $648 a month, $7,776. But they're telling me that I don't qualify for that mortgage anymore because I got to make 20 grand more. Come on, boss. I need this house for my family. Can I have a $20,000 raise today? I need this. Otherwise, the bank's not going to give me the loan. Do you think the boss is going to say, oh, dude, yeah, I got you. I got you. Here's $20,000 more every single year? Absolutely not. So what has to happen, folks? Well, mathematically, here's what has to happen. One of two things. These people that can't no longer afford an average house either have to buy a cheaper house. Guess what? There is no inventory, right? We already said there's a shortage in inventory. So you think those cheaper houses are there? Nope, they're gone. And they will continue to be gone because they're getting gobbled up. Okay, so what's the next thing the person has to do? Well, they have to rent. They have to rent until they can find one of those cheaper houses. Okay, so remember back to why rentals will be a good investment during this? Yes, but that's because there's going to be people that need to rent. But realistically, what's really going to happen and what are you seeing already happen? This has to come down. The price of real estate will come down because it has to. Because otherwise, the people that own these houses, the builders, the hedge funds, the neighbors that want to sell their house because they want to move to Florida or somewhere else, whatever the reason is they want to sell their house, they can't get this price. You're not seeing this now because the average person selling a house right now that you're making an offer on, they're still looking at a Wall Street Journal from 9 months ago saying, the market is so hot, like I'm going to get this price. It hasn't sunk into their stupid head because they're looking at old news. They still think that they're in a reality world where they're going to get that price. They're not. So as time goes by and they still need to sell that house, they're going to keep dropping the price. They're going to drop it once, drop it again, drop it again. No action, no action, no action. Maybe they start getting lowball offers and they're going to eventually drop this price. And now maybe that $350,000 house comes down to $299,000. Don't think that's possible? Watch, because that's about what's going to happen. I don't know if it's going to be $299, but it's going to be a drop. You will witness this happen in the next 6 months. You'll see the housing stock, the price of housing, including new builds, drop lower and lower. Just pay attention. Pick any house, any address that you've ever done that's on the market. Go to Zillow and just once a week or once a month, start looking at the price and just keep watching it, okay? Because it's starting to dry up. People can't afford houses. So this is why real estate's going to go down. And this is why you must act now on everything that you're going to do, because you need to get ready for this. If your house is worth 350, get that equity out now before it's worth 299. If you're looking to buy a house, well, I don't really know what to tell you. It's a little late for that, or just go to your boss and ask for a $20,000 raise. I'm just trying to be realistic as to what's happening, why it's going to happen, so that you all can start really understanding that I'm not making this stuff up. I'm not coming up with my own little opinions for because I'm trying to sell you a HELOC or something. Folks, we don't sell HELOCs. I got nothing to gain by any of that. I'm simply telling you what the future is going to look like. And I'm telling you right now, if you haven't gotten the equity out of your house, it's time to get it out. It's time to get that home equity line in place. Now, if you don't have anywhere to use that money, okay. But realize when you get a home equity line of credit, okay, and I want to give you a history lesson here. Let's say you got a home equity line, you did what we said, it's got 100K in it, and you just sit there and you do nothing with it. You think the bank could come in and say, we're no longer going to offer the 100,000 even though you qualified for it? Absolutely. During the pandemic, they did. During 2009, 10, 11, they certainly did then. They've probably done it other periods of time. Folks, this is here today, gone tomorrow. So if you have a home equity line and you're not using it, let's draw a line in the sand, okay? You got your home equity line, or you got your equity in your house, however you're going to access it, over on this side. And over on this side is what I'm going to call your opportunity, okay? So that if this is your opportunity on this side and your money is just sitting over here, even though it's no longer lazy in your house, you've got that HELOC because you listened to the first part, but then you failed to launch. What we need to do is we need to now look at what are the opportunities. Well, first step, let's look at your debts always, because in a recessionary period, I will tell you wholeheartedly the first reason you will fail in a recession, the first reason you'll go bankrupt, the first reason you'll experience financial hardship is not because you lost your job, it's not because your 401k went down in value, it's because of this, because of debts. And I will also tell you, if you look at stats and statistics, debts have been climbing. It's revenge summer. Let's go spend some money. Let's go buy that Porsche. Let's go buy that new car. We got to have that boat. Oh, during the pandemic, you had to have the RV. Oh, but now you don't need the RV. Oh, we don't really need that, so let's sell that. Sorry, it lost value. So you have debts. So we need to first and foremost focus on getting rid of these, okay? If you don't have debts, we can look at secured investments or secured places like real estate loans or rental properties or a whole suite of other things that all are secured by a tangible piece of property and put you in a first position. So we can look at those, okay? That's another option. And I could keep going with these, but what we need to do is we need to get this money out of the home equity line of credit, and we need to get it over here into an opportunity. Every one of these opportunities, including debts, are going to have an outcome. So if we use the home equity line of credit, we pay off all your debts. The outcome is all those monthly payments that you were giving away to your debts now can flow back over here as a recapture, okay? You can then take the money you used to give away to them, and now you can pay it back to you. You can start paying off that home equity line or refilling that money or doing a number of different things. Or maybe it's not the debts. Maybe you take that and you lend it through Private Money Club. The outcome is not going to be recapturing. The outcome is going to be new interest, okay, that you're going to earn. We'll call that the spread, because remember, there is a cost. We're always working off of a spread because that's what a bank does. And we get that money back over to this side. This side is you controlling the money. This side is you losing control of the money. Any questions? So that's just lazy cash. And that was all that we didn't plan on talking about it that way, but the cat jumped up and I'm like, hey, this is lazy cash. Hey, by the way, let's talk about lazy cash. All right. Do we have any questions on that, or should we move to the next topic?
I think we can move on, but that, what you're saying is so important, because you're tapping into the lazy cash. Like, that is more important than ever before, because when you were showing the house prices coming down, like when I see house prices coming down, guess what happens? I see dollar signs, because that's an opportunity. I can start buying stuff on sale again. I can start making money doing that. And when we look at the United States and the population, what's going on right now, I mean, look at this chart right here. So this shows U.S. personal savings near historical bottom right now. So you can see this was going into COVID. They did all the stimulus checks and all the free money and everything was passed out. So we saw savings shoot up during the pandemic. Nobody could go out before the summer of revenge and everything. The red line is going to be credit card loans. So you can see a lot of people got money. They paid down their credit cards. They weren't spending money. They couldn't go out. So savings went up. Credit cards went way down. But look what's happened now. And if you look at inflation, inflation really started to take off right around this area right here, beginning of 2021, going into the middle of 2021. And since this has occurred, savings now at historic lows. And look what's going on. This is the scary part. Look what's going on with credit card loans. And as rates increase and increase and increase, those credit card loans are becoming more and more and more expensive on a monthly basis just to cover interest charges. So we're in a position right now that everything you're saying right now, Chris, is going to be more important than ever before.
And this is just normal, folks. This isn't like some like consolidated or like some time in history where this is the only time this has happened. Every other inflationary period results in the same, because people don't save money. They spend money because they're scared to save money. They think cash is trash because they watch too much of the news. Shut the news off. I don't care what station you watch. I mean, hey, maybe turn it on to see, what's going on with the elections, or maybe you want to catch the headlines, but stop buying into the nonsense. It's all toxic, if you ask me, especially when it comes to the money side of it. If you listen to Jim Cramer and you're taking your stock picks or stock advice from Jim Cramer, first thing I got to ask you, how's that working out for you? Oh, wait. We already know it's not working. It's not working at all. The dude gets it wrong more than any human being I've ever seen in the stock. We'd be better off just having Cash meow and we just make up a stock that he said. So Cash, what kind of stock should we buy? He meows and we say, oh, he said, buy Netflix. And we just buy Netflix. It's the same thing as listening to Cramer, except for Cash is going to get it right more than Cramer is. It's just ridiculous. So the other things that he just showed there was the savings rate going down, the credit card rate going up. And do you know why that is? The cost of everything is going up. Inflation is driving gas up. Okay. Actually, gas is a whole nother topic. I don't even want to get into gas and diesel because that's being manipulated in a way that's just sad. It's just downright. It's actually insulting, and it's embarrassing that they're doing what they're doing with the oil reserves to support gas prices to buy votes. It's sad. It really is. And if you think that they're doing it for any other reason, you're wrong. Because never in history have they ever gone into surplus to try to control price. It's not meant for that. But anyway, I digress on that. The other thing you have to—
I can tell you one thing, Chris. We'll give you solutions on what to do for this, but this right here is not a solution. I saw this headline the other day and I almost fell out of my seat. You know what I read when I read this was majority of Americans back using gasoline to put out fires. What? So just if anybody's looking, it says majority of Americans back new stimulus checks to combat inflation. So I think that comes from a little bit of mindset of we think that, everybody's going to bail us out. Something's going to come in and save us from the day. Well, guess what? That doesn't always happen. So rely on yourself and yourself alone, because I don't think that we're going to see a lot of that stuff happening in the future.
Yeah, well, they're not going to be able to, because the Fed, which controls monetary supply, which means they control how much money's in the system, is not going to print money right now. Okay, the Fed is not printing money to try to help everybody, combat inflation. I don't care what the news says. That right there, that's a political ploy to get votes. And I don't care if it's Republicans or Democrats doing it. They all do the same damn thing. They're buying votes with headlines like that. The Fed controls monetary supply. Do not ever think that the government does. It's the Fed that does. The Fed right now has outright come out all year long saying their number one focus is to bring inflation down, which doesn't mean print more money, give more people stimulus checks, pay off more people's credit cards and student loan debts. It means suck money out of the market, stop banks from lending money, make money so expensive that people don't want to borrow money, because it got to slow the economy down. You got to stop people from spending to control inflation. It isn't working yet. So if it's not working and the Fed's not getting their desired result, what do? You guys know, when the dentist isn't getting deep enough for that cavity, what do they go? Deeper. And then all of a sudden the Novocaine didn't quite go far enough down and you squeal like a little pig. Well, that's exactly what the Fed will do. Put more pressure, dig deeper, pull more money out. They're already taking $95 billion out every month of the capital markets. And they do that by unwinding their balance sheet, sell the debt that they've been holding in the open markets. It sucks money out of the markets. At the same time, raise interest rates to start making things more expensive. And folks, I don't care what they said on, oh, we might start easing back in December. Well, the data, the numbers will prove that. And I'll tell you, if people are still employed, if companies are still hiring, which it's slowing down at the top, but right now, like because of hospitality, airlines and everything, there's lots of jobs. When people are employed, guess what they're going to do? Spend money. When people are employed in a high inflationary period, they spend more money because they're scared to hold cash. That is the wrong thing. You should be holding cash. I wouldn't say hold it in the bank. Start your own bank, like get around the table that we're going to talk about tomorrow and also this weekend at the 3-day training. And we're going to show you how to create your own banking system. And just so you all know, whatever your bank pays you, okay, that you can be happy about it. It's probably less than 1%. The insurance companies that we use right now, the lowest one that we use is 5.2%. So do you want what the bank pays you or you want 5.2%? Which one are you looking for? What the bank pays or what the insurance company pays? Okay. And then, yes, there's some things we got to talk about there, but it's a very simple question. You want 5.2 or you want less than 1? Easy math, right? So we're in the midst of lots of things. Russia, Ukraine, squeezing oil, squeezing gas. It's going to affect Europe. Europe and the US are tied because it's a global economy. This right now, you're not hearing you're hearing about the Russia-Ukraine war, but not much because it's midterms. You're only hearing about elections. You're only hearing about what they want you to hear about. Cash, get off mine. Sorry, cat's trying to type. Okay, so that's going to have a big impact going into winter. We're going to enter the winter season. Now, I don't mean just snow. I'm in Buffalo. It's definitely going to snow here, but I mean the winter season. Look it up. Summer season, winter season when it comes to finances. Yeah, you got globalization and the end of that. I'm going to tell you right now what this administration, what they're doing right now with the Middle East and with OPEC, where they're trying to threaten them. Here's what OPEC's going to do. Mark my words. Here's what the Middle East will do. We push hard enough, they're just going to be like, okay, great. You guys don't want our oil? No problem. Because Russia will buy it and China will buy it and India will buy it. We got plenty of people to buy our oil for more money. You guys thought you guys were the big guys, but what if we just value our oil in a different currency? It's game over. And that comes right over here. Oil in trade, the reserve currency. That's the reason the US dollar is as high as it is. But that's on the chopping block right now. Okay, there's a lot of things going on. That could go away in the next couple of years or next decade, and that will not be good for this nation. US dollar, digital currency, whatever, Fed balance sheet, we've talked about all that. But this is really what it comes down to. Ray Dalio's, one of the smartest minds in this. He talks about the debt cycles, long-term productivity, long-term debt cycle, short-term debt cycle. All of these are at the end of a cycle, including the technology cycle. You're seeing it already. The big FANG stocks, okay, Facebook, Apple, Amazon, Netflix, Google, FANG. All of those stocks, which were the prized tokens. Apple still might be, but they were all the prized tokens. How are they doing now? Their outlooks are coming out weak. Okay. Many of them are missing their earnings expectations. Almost all of them are either freezing hiring or laying people off. Okay. Forget about Twitter. We all know what's going on there. But all of them are starting to cut back. They're seeing the slowdown coming. So you're seeing it at the top. And what happens when things happen at the top? Don't they always trickle down? Yes, they do. And it's going to happen relatively quick. So all this stuff that you're talking about, we talked about the rising rates. We barely talked about the inverted yield curves, but it's been all over the news. The inverted yield curve, you get paid more for owning a 5-year treasury than you do for a 30-year. That makes no bloody sense. Oh, wait, it gets worse. You get paid more for owning a 2-year bond that matures in 2 years than you do for owning a 10-year bond that you got to hold for 10 years. That makes no bloody sense. That's right. All these are signs. And every time the yield curves invert, it always results in a recessionary period. So folks, we're not making this up. I don't care what the yahoos say. We need to start understanding how to fight this thing, and how we're going to fight it, and how we've taught it is, well, we've talked about treasury bonds. We've talked about treasury inflation protected securities. Any of you that got around the campfire and listened to us and went to treasurydirect.gov, ever since you bought those I bonds, you made 9.6%. Yes, I know they reset every 6 months and we're going to go down to around 6%. That's still pretty good for guaranteed money. Okay. Treasury bonds, any of you that have been buying those, you're going to benefit from those in the long term. It hurts a little bit now because they're going down in price, which is exactly when you want to buy. We don't want to buy assets that are high. We want to buy assets that are low. Buy low, sell high. So like folks, this is March. I'm giving you old news because I want you to understand that what we were teaching you then has materialized, and every single thing that we showed you has really benefited you. So if all of this is then we got to talk about where you're going to move that money. And this is what we're really, really going to hyper hit on tomorrow, and more specifically this weekend, because we got to decide what we're going to do with the money in our 401ks, our 403bs. Whoops, missed the one. 403bs. We got to really hit on those because a lot of your money is sitting in those, right? How many of you have 401ks on here? 401k, 403b, 457, employer-sponsored retirement plan, or IRAs, traditional IRAs, not self-directed. Okay, so a couple of you chimed in. Now let me ask you: have any of you made changes to your allocations of your 401k, 403b, 457? Now put change. Any of you made any changes to them? So a bunch of you listened. Great. How many of you did not make changes and kind of wish you did? No one wants to admit that. That's okay. But wouldn't it be nice to know what to do with that? Wouldn't it be nice to know how to protect that money? Because right now I got a couple words: preserve and protect. And I'm not talking about law enforcement, folks. Preserve and protect. This is the only thing you should be focused on right now. If you're focused on, oh, I gotta make up for lost time. Oh my God, I gotta make up for the losses that I just had. And if you think the answer to that is take more risk, that is going to end very badly for you. It is preserve and protect. And right now, the biggest word on the street that all of you need to learn how to do is how to make a positive spread on any monies that you have. I don't care if it's your 401k, because some of you can take loans from your 401ks. You know, I've been teaching this for, gosh, the better part of 5 years about how to use loans from your 401k to do the same thing we did with the home equity lines of credit. It actually works better, but not a lot of people do that. All of it.
I got one question real fast, Chris.
Right.
Sharon just said hers is managed by ML, I assume Merrill Lynch. I'm just curious if you have a financial advisor, money manager, or something like that, are they having those conversations with you where you're reallocating, you're moving it, you're making changes? Are they telling you what they're doing, and how's that going? I'm just curious. No. Okay. Maybe something to think about.
I'm sure by now, when you guys have gotten your statements, guys and gals have gotten your statements, you've called your advisor, maybe your 401k manager or something, and you told them, you know, I'm a little nervous. I can't keep taking losses. What did they tell you? Can anyone tell me the one thing that you've heard from your advisor when you've asked about making changes to your current assets, your current retirement, or your current investments? Gave us a tough time when we took all our money and moved it to a self-directed. Crickets. Come on, somebody has to. What else? Someone has to have asked. Please tell me you guys you're talking, folks. You got to talk to your advisors. Like, what are they saying? Oh, bingo. That's what I was looking for. Stay the course, right? Anyone else ever heard that? Stay the course. Anyone? Dave is awesome. That's what you heard, Dave. Was that because you heard it from us? told to stay the course. Okay. So does everybody understand what staying the course will mean? Like, why would they say stay the course? Can someone say, you know, like if this is the cycle, and I'm just going to draw just how it's going to be, right? This is the cycle, and this is the downward part that we're going into. Okay. So this is, I'm going to do that in red. And then this is the next. These are the cycles. Okay. You got cycle there, you got a cycle here, and you got a cycle here. This is about a 10-year, I'm just going to put 10 years, okay? From peak to peak, okay? It's about a 10-year cycle. All right, keep investing, buying the dip. Now that's good advice, Jeff. Dollar cost averaging, they'll still get paid. Yep. We're talking about new money though. If they say keep it, that's smart advice that your advisor gave you about keep investing, because buying the dip, you know, what you want to do is you do want to start buying as it goes down, right? So if you're dollar cost averaging in, buy the dip, if they call it, that's great. But this is new money. I'm not talking about new money, folks. I'm talking about what they're telling you to do with your existing assets. Okay. Won't be good. Advisor still gets their fees despite their assets. Good answer, Chris. But here's what I want to do. These are factual numbers. Okay. I want you all to understand one thing. Stay the course might work if you're young. Okay. But it's still going to be very painful. And most people don't make it through it, because when this starts happening, fear sets in, reality sets in when they lose their job. And then all of a sudden it becomes a decision. Okay. And this is 2009, 10, 11. Honey, should we keep the money and stay the course like Jibby told us to do? Or, you know, should we pay our mortgage payment? What's your wife or husband going to say? We're going to pay the mortgage payment. Who cares what he said about stay the course, or she said about stay the course, right? That's reality. Fear drives emotional decisions. Okay. We always want to make logical decisions, not emotional, but fear drives some decisions. And most people, when they hit fear, is at about a 30%, like serious fear is about a 30% down. Okay. So when you're your portfolio is down 30%. That's when the real fear sits in. It's been proven. Okay. But when it hits 40 and 50, that's when, oh, it's not going to go that low. Right. Okay. That's what your advisor said. Stay the course. It's not going to go down another 20 or 30 or 40%. Yes, it will. The numbers show that. The charts show that. You can see it clear as day. If this thing lets loose, we are going to see another 30, 40, 50% drop in the market easily. Okay. Stay the course. So let's just put some numbers to this. Let's just assume you took your advisor's, you took your advisor's advice, right? So let's just do the math. And let's start at 10%. Okay. So the market's down 10%. According to the drawdown effect, and I'm just going to write that because I want you all to understand this. Because I know what your advisor is saying. Do you know why I know that? I was one for 16 years. I know what I told my clients: stay the course. Keep investing. This is the best time to invest, which is solid advice. Dollar cost averaging in is solid advice. But I'm talking about your current assets. So the drawdown effect says that if we lose 10%, what I'm going to do is I'm going to draw a line over here. If we lose 10%, we got to make 11% back just to get 10. No big deal, right? Okay, well, if you lose 20%, this is where it starts getting real. You got to make 25%. So you got to make an additional 5% just to get back your original 20. No big deal. We can do that. I would stay the course, 10, 20. Why did I say 30? Okay, now look at how the number changes. If you lose 30%, it's going to take you 43% just to get back to 30. Do you see why 30 is a critical number? Because now you got to make an additional 13%. How many of you can tell me what the average rate of return is on the S&P 500, the Dow Jones? About 7%, depending on what time frame you're looking at, right? So if it takes you an extra 13% just to get back the 30 that you lost, you got to make 43 back. The S&P 500 doesn't even average that, ever. Maybe you have good days, bad days, but it doesn't average. Now, stay with me, folks. 40%. 40% takes you 67% just to make back your 40 you lost. How many of you still want to stay the course? Anyone? 50%? I mean, it just gets worse from here, is 100%. So that's what stay the course means. Now, do you see why I argue with advisors? Now, do you see why I don't believe stay the course, invest for the long haul? Warren Buffett does it. He's playing a different game, asshole. Stay the course means you are accepting that you understand the drawdown effect. So if you lose 10, you got to make 11. Sorry, that's long gone. We're way lower than that. Oh, we're at 20. Yeah, you got to make 25 back. No big deal. 30. The second you hit that, you got to make 43. That ain't happening, folks. It's going to take a long time. It's why during 2008, when the market fell and people got out at 43% or stayed in, it took them almost a decade to get back what they lost. Almost a decade if they were paying attention to the numbers that what their high point was to where they were. Almost a decade. How many of you want to give up a decade? It's a long freaking time. That means your newborn child is now 10 years old. That's how I look at things. That's a decade. Okay? Don't buy into this bullshit. And I don't mean to be an asshole, but you know what? I'll argue with your advisor. I'll tell your advisor why they're wrong. I will go as far as it takes. You can't accept this because you're not going to just lose 20%. You're not going to just lose 30 this time, folks. This is what we're really looking at here. Another 30, another 40, another 50% drop in the markets. Just look at the charts. We've done the math. You can't afford to have to make 43, 67, or 100% more to get back just what you lost. So don't buy into the crap. So you just had this little thing because of the midterms. So let's just say here's where we're at. We're about 25% down, give or take, depending on what you're investing in. And you just had this little pullback. That's about what it looks like, okay? This is the pullback that they're talking about. This is the pullback that everybody's like, oh my God, it's over. It's going to be good. Let's buy back in. This is where you start to plan your exit. And this is probably going to be your last exit. It's kind of like, when you're on a throughway going 65 and your engine or your gas light goes on, the light, you're just about to pass one of those throughway stops and you're like, they don't have a Starbucks. I'm going to go to the next one. And then all of a sudden your car has 20 miles to go before it's empty and the next rest stop is 40 miles away. You missed the opportunity. This is the exit you need to get off on if you can't handle that bumpy ride down. That's reality, folks. Many of you don't really understand the advice I just gave you there. I just showed you what stay the course looks like. Your advisor will always disagree with me. You know why? Well, they're getting paid to have your money invested. I'm not. So I'm telling you the truth. I got nothing to gain. Anything I just told you, do I make any money on anything I just told you? Not one red cent. Who does? Your advisor. Stay the course is the age-old tale that they want to tell you, because the longer their money is invested, the more their monthly check rolls in. When the market goes down another 20, 30, 40%, sure, they get a pay cut. They still get paid when you're losing. How it works, right? Now, Sharon, I want to be clear. We are not talking about taking the money out. So everything I just said, I don't know how we got off the rails. I am not talking about taking money out. If you got a 401k, okay, in your 401k, you have, and how most of you know, you have conservative, moderate, maybe moderate to high. You might have a blend, okay, and then you have high risk. Okay, this is about how they classify. These are the risks, and this is how all 401ks, show you the funds. And then for conservative, you maybe got XYZ fund, you got cash, you got money market, stable value. Okay, these are conservative, moderate, high, maybe you got international. These are what you want to avoid. So in your 401k, if you've got 100% of your money going to that Freedom 2045 fund, and I bet you many of you have that exactly. You're like, wow, how did he know? Well, because these are the highest feed funds inside your 401k. So I know where the advisors put you, the highest feed funds, the freedom funds, the retirement date funds, all the ones that make it seem so easy for you that you don't have to do anything but put your money into this target date fund that over time is going to self-adjust. And guess what? That's probably in these risky assets for the majority of it. Maybe a tiny little bit here. What I would suggest you do is you reallocate this to a safe conservative fund. Maybe a AAA rated corporate bond or a treasury bond or a money market, somewhere where it's not going to lose what these ones will. So now all of a sudden, if you got 100K and your allocation is, I don't know, let's just say 60%, 40%. This is stocks to bonds. Okay. I would suggest probably getting this to change a little bit, because that's a broken model for right now. And I would almost go as high as 80 to 90% conservative. Okay, which is primarily the right types of bonds, but not all bonds are equal, or just go to cash. That's not a bad option. But then what you want to do is, and I'm just going to draw over this, if this is the market going down, new monies, this is just existing money. So all you did is reallocate. You didn't take money out of your 401k, which triggers taxes and penalties. You're just reallocating. New money's going in. What I would suggest you do is the new monies, whatever your risk tolerance is, keep buying in. So if you're putting in 3% per paycheck, great, keep buying into the riskier assets, okay? If you're putting 6% in, keep putting into the riskier assets. If you're putting 14 or 10 or 14 or whatever percent you're putting in, what the hell are you thinking? If they match you 3, why would you put more than 3 into your 401k and give up control? Anyway, we'll cover that this weekend. Yeah, I just want to be clear. I'm not talking about taking money out of your 401k. I'm just talking about moving things around, shuffling them around. Taking money from my right pocket and putting it in the left, because the left has more insulation and it's protected. That's all.
All right. Well, we're getting down to the end of the time here. So I want to maybe just kind of highlight some of the things that we'll be continuing with tomorrow, and then what we'll be getting into this weekend. And then I know we wanted to kind of do a little special bonus for anybody that stuck with us till the end that wants to join us this weekend. So if we can maybe get into that right now, that'd be awesome.
So one of the things we'd love for all of you to join us this weekend. This weekend is recorded. Okay, you're going to get in fully edited. Even if you can't make it this weekend, I'm sure some of you have weddings. You got to take that last getaway trip to Hawaii, whatever it might be, and you can't make it. So you're going to make the excuse that that's why you're not going to come to it. Well, what if we said we're going to record it? Then we're going to edit it into sections so that no matter what it is you want to learn, we're going to send you that, and it's going to be really easy to find. Would that change your idea? Because this information that we're going to give this weekend, this is the only time we're going to do it. It's not like we're going to be doing this every week. We're not going to be doing this on Wealth Webinar. This is a highly concentrated, brand new training, because every one of these 3 days, we do brand new trainings. We got new speakers coming on, new topics coming on, and it's all geared around right now. What now? That's the topic of this weekend's training. So if what now is everything that we started to hit on tonight, what we need to talk about is, what do you do next to get ready? What do you do with your 401ks, your current assets, everything that you've got, and how do you get ready? And we're going to dive deep into the banking concept, which I know many of you were here because you wanted to learn about that. So Stephen, can you put the link up? So the 3-day event this weekend, Friday, Saturday, Sunday. Okay, we do all day, all 3 days. You can, join us for as many of the days as you want. We have a high participation rate. Usually it's 90+% the entire time, but maybe you got to step off to watch the game, right? The Bills are playing. Maybe Sunday you don't want to, miss the game. So you're like, I'm not going to make that. Great. We'll send you the recordings, like I said. So normally it's $297. That's what we charge for the 3-day. It's what we've always charged. So I got a special. Now I had these boards made. Now I don't care if you skateboard. These are cool memorabilia. These are all numbered. And last time we gave some away, this is number 43 of 50. There was 50 of these BYOB skateboard decks that were printed. Okay.
I got one right here too, just so you guys can see.
There you go. Okay. So what we will do is we will ship you one of these limited edition, because once the 50 are gone, there will be no more. One of these limited edition skate decks. You can give it away for a Christmas present. These are made by Penn's Wood. This is literally the top of the top when it comes to skateboard decks. Maybe you don't have anybody that likes skateboards. These make really cool things to put on your wall. Be your own banker. Okay. But maybe you don't want a skateboard. Great. We're going to give you an option. You can either do the skateboard deck, or you can go online and you can pick any of the shirts that we have on our store at chrisnoggle.com, and we'll send you whatever shirt, whatever size you want with any of our logos on it. Okay. So that's the offer. So it's $297. You get the skateboard deck shipped to your house, or the t-shirt shipped to your house. And that is tonight only. Was there anything else we wanted to give them?
No, let's roll with that. I just set a marker in our tracking system, so we'll know everyone that does it right now will be getting a board or a t-shirt. Just let us know, and then we'll cut it off. What do you think, Chris? Because if anybody's watching the recording, this is not good. You got to be on live. Yeah. So only if you're live, you're with us the whole time right now. So I'm going to cut it off at like probably 10 o'clock tonight. So anybody that wants to join us, I'll put the website. It's moneyschooltraining.com/registration. It's in the chat box. And I'll just share my screen real fast and show you guys.
Let's do this because everybody's here on election day. A lot of people made some serious changes to their schedule. I wasn't going to do this, and Sean will probably be pissed. But why don't we let's give the deck or the shirt away, and then do you have that coupon code? So put the coupon code in there. So anyone that signs up tonight only, not tomorrow, tonight only, you'll get the deck or the shirt. And you're going to get a coupon code that makes the price of the ticket $197, not $297. And then there you go. Virtual discount is the code. So when you go to that website, there's a discount code. You're going to put in virtual discount. And then also what we're going to need to do, we're going to know just by everything. But if you want a shirt, you're going to have to let us know what size shirt you want or what specific design. So go to chrisnoggle.com, pick the shirt, and then you can email those. I don't know, you can just send them to me. Send them to, what do I want them at? Send the shirts if you sign up today, and we will cross-reference to make sure that you bought a ticket tonight, okay? If you want a shirt, you just pick the one you want, what color, white or black, and then what size, and you can email me at chris@themoneymultiplier.com, and all I'm gonna need is just the shirt size and which one you want, and we'll get that taken care of, I think. I probably did that all wrong. What about a cap? Yeah, what the hell? If you want a baseball hat, I don't have any of them over here, but the new BYOB hats,
Hey, Morgan's a good guy.
If you want a hat, I'll give you a hat. I don't have that many left. So when we run out, we run out. Same with these. We only have probably about 20 of these. I don't even think I have 20, maybe 15 decks left. So there's 15 seats, hats. There's probably 10 left up front. So if you want a BYOB hat, a t-shirt, or the deck, $197 tonight only. Sign up for the 3-day. I don't know. That's way too good of a deal. I don't even know.
If you've taken it in the past, remember, this is all new information.
Yeah,
times have changed in the last 6 months. Like, things are different. We have on new speakers, new experts. So it is much different, even if you've attended one in the past.
And wait, there's more. For one lucky person, I'm going to mail you a lazy. I'm just kidding. You're not getting my cat.
So you can go to the website, just tells you a little bit about it. I start at 10 a.m. Eastern every single day, right at 10. And then it says we go till 3:30, 3. We usually go a little longer. So just plan on staying a little longer. Sometimes we'll throw in an extra bonus session here and there. There's a couple little changes. Chris Root couldn't make it. So I actually found something really, really, really cool to fill this spot, Chris. I haven't even told you about it yet, but we'll talk about it tomorrow. So it's gonna be a really good training, but you guys can go on here and check it out. I mean, it's, just to give you an idea, we started doing this training at the beginning of 2020 before COVID even hit. And we were doing it live and in person, and then COVID hit and we brought it all virtual, and we've been doing it. We did 6 of them last year. We did 4 of them this year. We'll probably do 1 a quarter next year as well. It's become our flagship training. So if you really wanted to take back control and really get in deep with us and what this is all about, this is the 3-day training. I mean, it's $197. So it's basically free. And so, this is the starting point. And from here, you'll really be able, and just so you guys know, we don't sell anything more. Like, we don't have $30,000 coaching packages or anything like that.
But we don't.
We probably could. We just, we just don't. So again, this is literally 3 days of just education, and it's truly life-changing. Email me if you can't get it to work. We'll make sure we reserve your ticket and the board and everything like that. So if you need to email me or if you have any questions, let me know. But
Screen real quick.
Shakira, you can enroll until Friday. I mean, you can enroll Saturday if you want to. You'll miss a day. We'll send you the recording. But if you want to get the bonus and everything, that does expire later. So
yeah. So here's where you do it. So it does work. It just took me a little bit to get into it. So you go here, click here to enter your code. So there's your coupon. Okay, that's where you'll enter the virtual, your information. You just put it all in. And down here in additional information, right here, instead of emailing me, why don't you just give me, if you want the hat or the shirt and the shirt size, just put it in the additional information. That'll be more than sufficient. And yeah, somebody's asking, is there any opportunities to guidance regarding individual financial circumstances? That's a great question, Marco. So if anybody wants to talk about anything we've been discussing tonight, the infinite banking concept, if you want to talk about, self-directing your retirement account, if the 3 days right for you, anything like that, you can schedule a call with me. I'll put my link in there. So my call calendar is on that link. Click right there. Go to my call calendar. If you need to register for the webinar tomorrow, watch the What the F tomorrow morning, all that is on that link also. So go there, schedule a call. I don't have any openings the next couple of days, but I do have time. So if anybody wants to talk before the 3-day training, just text me. And I'll just give you a call and we'll chat real fast. So I put my cell phone. I always have my cell phone on me. The PMC phone is right here. So we got this right here. So you guys text me and I'll give you a call before the training. Or if you go to that link right there, you can schedule a call with me for next week. I'll have plenty of availability next week. And we could talk about your individual situation if this is right for you. All right, Chris, I love it. A couple other things. Unanimous had asked mortgage reps for HELOCs. We're going to have those they're not mortgage reps. We're going to have Matthew on, who's going to show you how to get the HELOCs and how to get the HELAs. And then how does this work if you have I love this question. A lot of people are like, oh, if I have no assets, no equity, no 401k, that's perfect, because then you're in a really good place, because we don't have to protect and preserve anything that you've already made mistakes on. We can really just show you how to position and get ready to really take advantage of what's going on here. Did you guys get some value out of tonight? If you want more, we'll be doing this again tomorrow at 1 p.m. Eastern. We'll do a whole nother one. It'll be some overlap, but for the most part, we'll probably get a little bit more into the BYOB, the banking, and using your own bank for things. Yes, lazy cash is always good. Treats for lazy cash. He eats just fine. Did you see him? He doesn't need any treats, Tess. Does not need any more food. Or that was Teresa, sorry. Awesome. All right. I think that's a wrap. Steven, you want to stop the record, and I think we can call it a night. So anyone that needs to go out and vote can go out and vote. Otherwise, you guys can just digest some of the stuff that we went over tonight. No problem, Mike.